done here, and I'll make sure that I add you into it.
Mhm.
And every week that email really is try not to just junk it. It's usually just educational stuff.
Okay.
If you would prefer me not to email you, let me know. But so today I started in on property taxes. I know last week, Sean, most of you should have gotten the one regarding tax prorations at closing and title insurance prorations at closing. These things are really common questions, but Texas property taxes in general are, people think they know about them until it's time for them to get one. So, I'm not going to read, won't read to you verbatim here, but the first section is talking about how we all have, each property has different entities that will tax them. Most properties are going to have at least three. You're normally going to have city, county, and school. They may all be collected in by one entity, but there are a lot of places, for instance, in Carrollton in 75007, they're part of Dallas County, or I'm sorry, they're part of Denton County, but they're part of Carrollton ISD. Carrollton ISD taxes are collected by Dallas County. And so they can get confused when they get two bills here and they go, what do I do here? If they have an escrow account with their new lender, no problem. If they don't, obviously they're having to make a payment to two different places. There are other situations where you might have a municipal utility district, or for instance, Castle Hills, if you get up there, I think they actually just ended their municipal utility district. We'll call those MUD, is what we refer those as. But all in all, it's there to say that there are multiple entities for every property that have tax rights, and some of those exemptions and some of the tax rates apply to maybe one entity and not the other. For instance, homestead exemption takes off money and takes off exempting portion of the value that's taxable is how they work that. So if you have for instance, $100,000 property and the exemption for whatever exemption you qualify for is a $10,000 exemption, now they're going to base your taxes on a $90,000 tax base. So that's how these exemptions operate. Is they actually take away from the assessed value to determine a new taxable value. What constitutes a property? It's the first part is just really basically an introduction to what taxes are and what happens there. But then section 2, we jump into the exemptions themselves. And at closing, I typically will advise people that I'm not a lawyer nor a tax professional, so I can't necessarily dictate to them what they may or may not qualify for, but they certainly should be aware that these exemptions
they right by your right hand.
And that if they want to learn more, they can obviously contact the tax office to get those. But the three main tax exemptions that we see:
What's going on?
homestead.
Hey, look at you getting smarter.
Used to be. Who's got the? I need to mute somebody here.
Somebody.
Chuck, I think it's Chuck.
Yeah, turn off the microphone, please, guys.
All right. So homestead exemption. Again, it requires them to provide a $40,000 exemption to the residents, and goes into further detail. And so essentially, if it is going to be their primary residence, they file the exemption with the tax office. Most of the counties have an online form. One change that happened several years ago used to be you had to wait until after the first of the year, after January 1, to file the new exemption for that following year.
Somebody says
That is no longer the case. You can now file those exemptions right after you close. Most of the time, we tell people to wait until they've received the recorded deed from our office, which happens a day or two after disbursement, so that they have that evidence of the change in ownership. One of the other main and probably the biggest exemption that's out there is the over 65 and disabled exemptions. Talks about how those exemptions work and who can qualify for those. And then you also have disabled veterans and surviving spouse of disabled veterans, which are also another form here. I actually have that one myself, and there's different levels for their different levels of disability. The exemptions go all the way up to 100% exemption in certain circumstances. If you have someone in that scenario that is either moving from their old property or maybe a first-time home buyer that may qualify for this, they certainly want to contact the tax office to find out the requirements. Usually they just have to provide information from the VA and showing that they're exempt, their disability, and there's a notarized form and so on and so forth. Each county has their own requirements. So if you have a client that, either is qualified for these exemptions or wants to find out whether or not they are, they just need to reach out to the taxing entity, and they'll be happy to provide that information to them. We jump down here, and I'm going to skip ahead. Talks about some of the additional information, so it goes back to homestead and gives you a little bit of information about who can qualify for homestead. Obviously, they have to own the home on January 1, but as of January in 2022, this is when they changed it. The person who acquires the property after January 1 of a tax year may receive the homestead exemption for the applicable portion of that tax year immediately. So what that means is when they buy the house, let's say in June, they contact the tax office and they say, this is going to be my homestead property. If there was a homestead exemption previous to their ownership, the whole year will be taxed at the same rate, because if the seller was qualified and the buyer is also qualified, the tax rate is going to remain the same. Where you get kind of a weird situation is if you have a property that was not qualified and then now it becomes qualified. What they do now is they will actually prorate the exemption. So they'll give you the exemption for that portion of the year that you own the property under your applicable homestead exemption here. So, and it goes through some of the items with the same scenario you see with over 65. I see it less, and then that's what this next section is that I'll jump into, is you see it less where I'm exempt for a portion of the year. That usually doesn't cause a problem for us at closing. What that actually ends up doing is it lowers their tax base, and so we never hear anybody when we're saving money. Everybody's happy. They're only upset when they're getting charged extra. So go through and read the homestead stuff. That's the big exemption piece for your buyers to whether or not they're going to qualify or not. We also put some information in here regarding the over 65 and disability exemptions, and it talks about, again, that there's tax ceiling that they have in place for over 65. They can be paid in installments. They can go into monthly or quarterly payments, which is pretty common, and they can even defer payments until they, by tax deferral. So if you got, this happens a lot when you get elderly individuals, they'll defer the tax payments until the property is sold. So be aware of that. If you've got an elderly seller and you ask them about their taxes and they say, well, I don't pay my taxes. Well, be aware that that's going to come off your bottom line. So when you're doing your net sheet, you're going to have to take into account that they may have $20,000 or $25,000 worth of essentially back taxes. They're interest free, but I'm sorry, the interest does accrue, but they're penalty free rather. But they still have to pay them. And so when they sell that property, that's the seller's responsibility to pay any tax deferred properties. So item 3 here is talking about the taxpayer responsibilities with regards to exemptions. And essentially that just boils down to, on our end, is that it's their responsibility to file for those exemptions and to find out whether or not they qualify or not. I simply can't give them that information. You really can't either. Be very careful about, offering that information up. I always will, offer the advice and privy it with, but you need to consult your tax professional or the county tax office, because we are not the final determinant, and we certainly don't want someone saying, well, Sean told me that I could, that I was going to qualify for homestead, and now I'm not, and so I'm going to sue Sean for the lost money. What I think I lost in money on the property. So, but the big one that all this boils down to, and the really big reason I sent this out, I've had this happen a number of times last year, and I actually have started a new methodology this year to try to avoid this is supplemental tax bills. So what that means is that you've got a seller that sells their property middle of the year that was an over 65, had an over 65 exemption on the property. Buyer is not an over 65 exemption, or well, let's even say they have homestead as well, and the new buyer is an investor. It's not going to be homestead, and they're not 65, so they're not going to qualify for any of these exemptions. Okay. Well, that investor holds the property beyond the tax year, right? The bill, they buy it in June or July, they hold it, they rent it out, but the tax office never picks up on the sale, and they bill that current year's taxes with those exemptions on there, right? He pays the bill, nothing happens, everybody's happy. The following year, the investor goes and sells his property. That deed gets filed. Dallas County is the worst about doing this. They audit these. And they realize that, hold on, investor bought this property in 2022. And when he did that, we didn't, it was already after the tax assessment. And so the bills went out on the old exemptions that he did not qualify for. So now we're going to roll back and we're going to take back, we're going to send out a supplemental bill, which is for the difference of what he actually was billed and paid and what should have been billed and paid. Well, this always ends up in a claim, because what happens is that they sign documents at closing that says that if the taxes change, that the buyer and seller will work together to resolve that matter.
And that has to be removed at the end of the year of the descendant's death?
Right. It's really supposed to be automatic. The county is supposed to audit and see that a deed was filed, and that should trigger them to audit the account and remove the exemptions that may not qualify for. But they don't. And what happens is they get a year beyond, and they'll state that, you know, and I believe the statute says that the owner is responsible for contacting the tax office. At my closings, you know, I make you aware of this, not only for, you know, in my closing, I'm going to cover it, because I definitely talk to sellers and buyers about this. I have about 4 forms they sign up regarding this stuff. But at other closings that you're at, just make sure that the closer is, because a very thorough or maybe a newer closer is not going to be aware of this or have the experience with it to understand what's going to happen in the potential pitfalls. But yeah, what happens is they, you know, later that following year, you've closed and you've got a happy seller or a happy buyer, and suddenly the buyer gets a bill for, I had one the other day, $25,000. They rolled back for 4 years based on the prior owner's mom had died, and he had inherited the property, turned it into a rental, but nothing ever happened because there was no deed filed. It was just done through probate, and the title company that did that didn't update anything. So he was paying taxes with all these exemptions on him. Well, the county found out about it the next year and sent us a big, huge bill. And it happened to be at the end of last year during tax season. You've got a buyer that's freaking out because he's got a $25,000 bill he's looking at, and he's calling us and complaining and saying, well, you've missed something. You know, he's upset with his agent saying, y'all didn't tell me about this. Who's this title company you're working with? And it's a really unfortunate situation because there's not a lot we can do to avoid it. Until a couple of years ago, they didn't really do this that often. And Dallas County has really been aggressive lately. And some of the other counties are starting to follow suit. We're starting to see Collin County do it a little bit more. I don't see it a lot in Denton County. Tarrant County has done it as well. So it's something to be aware of. Now, the way we can address that, and something I normally will offer up to the seller, is to say, look, you've got homestead exemption that was on there for last year's tax bill that I can see you paid your taxes, but it was based on an over 65 exemption that you don't qualify for. I have one closing right now that's in that scenario, that it's an investor that owns it. They've owned it since the middle of the year last year. They paid the taxes based on the exemptions that are in place, and it's a Dallas County property. And so in that situation, I told them, I can estimate what the non-exempt taxes would have been, and I can collect those at closing, and I'll essentially hold them. We can't really send them to the county because they will just refund the money, but when they do it immediately. But what we do is we'll hold those funds and wait until that deed files with the county and kind of give them a minute to audit the file. And usually a week or two later, I'll call the county and see what they're doing. And if they do roll back those or they do issue a supplemental bill, we already have the funds to do that. If nothing else, that at least makes your seller aware of the situation and the buyer aware of the situation that's potentially coming. Most of the time people say, let's wait and see, because fact of the matter is we don't know if the county is in fact going to do it. Lately they've been doing it on most, but it's not 100% coverage. So we can't call before the transaction. The county won't talk to us about removing exemptions. They'll call it privileged information and they will not provide that to us. We can't call the county and get what the supplemental tax bill might be. They won't provide that information to us either. If the exemption was gone for the whole year, it's very easy for us to figure out. But in a situation where that exemption was lost mid-year, they're the ones that have to calculate what that proration is. And so we kind of get stuck between a rock and a hard place. And so at that point, really, it's just a matter of disclosure to all the parties to tell them what can possibly happen and explain to them, this is what the tax certificate looks like, and go from there. I was going to pull up, if I might have one, give me just a second. I'm going to give you this property is the one that has. So when I send over title work on your packages, you'll notice the two things I send you is a commitment and a tax certificate. The commitment is not going to make reference to exemptions, tax exemptions like this, but the tax certificate will. And just to very quickly go over this form so you understand what we're looking at here. This is what a tax certificate looks like. And page 1 is simply going to tell us what last year's tax bills were, or the current year tax. If the 2023s, this will actually show the current year, but what the base taxes were last year and what outstanding entities or what outstanding bills there are. So in this one, you can see the 3 taxing entities. You can see when they charged and what they collected last year and when they, what they were paid. Okay. And it's going to show us our tax ID number and then some basic information about our property. Page 2, however, is where this information comes into place. And you see that big red section, that's your dead giveaway that we've got something we found. And this is actually a liability statement from our tax provider saying the same thing, is that they've got over 65 exemption on this property. And if it's removed, they can roll back to, it works a lot like agricultural rollbacks. They can actually also issue a supplemental bill. And that's what this is showing us. But here at the top, this is where we would find out what your non-exempt taxes are. So if you ever want to disclose that to you, especially if you have an investor buyer and they want to know what my taxes are, prorations and everything at closing are going to be based on prior year taxes. That's because your seller is only responsible for what they are actually being taxed at. So if they're qualified for multiple exemptions, then they are only going to be responsible at the closing table for what they would be responsible for. The difference is when that responsibility, when that exemption is removed, that's going to be removed when that transition changes to your new buyer, and that buyer would then be responsible for that difference. And that's where we get that number from. I've got a lot of investor clients, when they sell the property, they will actually have me do their prorations based on the non-exempt tax amounts. They're doing that in an effort to avoid complications down the road when the bill comes out and the bill is 13,000 instead of 5,000. And they inevitably have to come back. They come back to us and we go back to the seller and say, okay, the bills came out and it's much higher. The tax base was different because you didn't actually qualify for these. And you've got to get money from one party to the other. And depending on the time of year, it can be problematic because they don't want, if those back taxes aren't paid by the tax due date, then there will be penalties that get assessed. So just to show you real quick again, one piece and one other piece that shows you is it actually breaks down the 3 entities. You can see county, city, and ISD here. It tells you who's collecting them, what exemptions are in place for those different entities. It will tell you the tax rates based on those. Okay. So those come into play if you have maybe recently improved property. You might want to estimate what the taxes are going to be versus what they were last year, because obviously when the tax assessor comes out, he's gonna base it on the improved value when that comes into play more often than not. And then if there's any other information, you might see some information back here as far as payments due, when payments are due, so on and so forth. But those are those big pieces of the tax certificate.
Great.
Any questions on that so far? I know I've went
So I'll
very
take the,
a lot of
I'll take the,
information.
yeah, okay, any question, guys? If you have any question, you can ask me personally after the meeting. And Josh,
Yes, sir.
still on share screen? Can you?
Yeah, I can take it off.
Yeah.
There we go.
Okay. Everybody will have a lot of questions, so I'll take care of it from now. Okay, Josh, thank you. And Melissa just got executed contract and she'll send you a file.
Wonderful.
Of
Yeah,
course,
I'll
it's in
email you.
Austin. Yes. Of course, it's in Austin.
Okay.
And that's her first file with you, and give her like very specific
Make sure I take good care
instruction.
of it.
Yeah.
I certainly will.
All right.
And Melissa, just FYI for your clients that are in Austin, I'll send a mobile notary out, or they can go to one of our offices if you like. We'll work that out directly with you.
Okay. Thank
All
you.
right.
Okay, thank you,
so much,
Josh.
guys. If y'all need anything, give me a call. Have a great day.
Okay, same to you. Bye-bye.
Bye.
오케이. 들어왔다가 나가신 분들이 있어요. 끊어지기 왜 끊어져요? 민주 씨도 들어갔다 나갔고. 오케이. 됐고, 다음 주는 모기지 하시는 제니퍼 씨 미팅 있으니까 다음 주 빠지지 마시고요. 오케이. 어저께 탑건 파밍 투어 열심히 해주셔서 결과도 좋았고요. 그렇게 해가지고 매일 나가면 결과를 가지고 오게 되어 있어요. 이렇게 하시고. 리코딩은